Kyler Johnson here to discuss Alibaba and why cash flow is king. First, I think we actually need to take a look at what Alibaba does as a company so you can understand the context that I'm going to give around my opinion on why Alibaba is a fantastic company. This is my opinion, not advice. So let's dive in. To understand Alibaba, let's jump into the four main areas where Alibaba operates and is generating revenue and profits. So as you guys can see here, just as an overview, Alibaba operates in the commerce and wholesale both within China and internationally. In fact, as you're going to see, internationally, they're expanding quite rapidly, which is really amazing to see. Movies and TV shows, and they're actually a fairly big player here, although this is not going to be our main focus for Alibaba today. The next piece that I wanted to discuss, because I think it's really important to go over when it comes to Alibaba, is understanding China, where they operate and generate the majority of their revenues. There's tons of talking going on about where China is right now, where it's headed. And so I think giving a little bit of context here is going to help you understand the framework within which to think about Alibaba. So first thing, I want to discuss the tailwinds that I think are following or pushing China, and along with it, Alibaba, as that's where they operate. First off, one of the biggest tailwinds that I see in the short term is that there is a little bit of a larger generation headed into the 35 to 45 age group, which is prime spending years. Another one that you see is there is still a high poverty rate. So as they lift their people out of poverty, that's going to increase the GDP in the country, increase spending overall, GDP per capita, all those kind of things. That's another tailwind pushing them. The next one is you've probably seen the government has already put some stimulus out there, and they're continuing to discuss how much more, when, all those kinds of things that I think is going to have a big impact and pushing spending. You guys saw what happened during COVID when the government really injected a lot of cash into the US system, and how much that drove consumption and honestly is still having lingering effects today. Not to say that it's going to be the exact same in China, but I certainly think we could see similarities there. Next, e-commerce, which is a big part of Alibaba's growth, is set to grow at 9% per year, and retail at 8% per year in China over the next several years. And the next thing that I thought was amazing to know is there's set to be 18% growth in the cloud in China. And that's going to be big drivers behind Alibaba and its growth. Obviously, the company has work to make sure they're capturing that, but these are tailwinds that are just naturally going to be pushing the company forward that you'll see in China. But as you guys know, there's still a lot of fear there, and I think it's totally justified to address the negatives and things that are going on there and how this could be affecting the company. Some of the headwinds that I see, there's a declining population. This is certainly real. China's population is declining as the birth rate drops, and people are just not getting replaced essentially with new kids being born, and they're going to see pretty significant declines over the next several decades. The next thing is I think there is definitely a certain amount of corruption in China that makes it a little more difficult to feel like you can trust all the data you have coming out, although I think the main data sources are correct, or as correct as you can be when you're dealing with that large of a data set. So, but it's something to keep in mind for sure. The next thing is their government has very strict control of a lot of things. And I've seen as companies fall in or out of favor with the government, oftentimes they can kind of get crushed just by changes in policies. Now, I don't think this is super applicable to Alibaba just because they are essentially a darling of the country, and they don't see any reason to want to squash that when it's going to really have a big detriment toward their public view. People around the world watching them crush one of the largest companies in their country. So this is a risk, but I don't think it's so big of a risk for Alibaba in particular. Currently, they are in a slight piece of deflation where prices are going down, which can have a snowball effect as people say, I'm going to wait to purchase this item because I think prices are going to go down. It essentially a self-fulfilling cycle as people wait to spend. The companies drop prices further, so people want to spend, and you can kind of see how that snowballs. And the last big elephant in the room is the housing crisis, and specifically Evergrande. Now, this is a serious issue as housing continues, the price of housing and the amount of growth that the housing construction sector is pushing is falling pretty significantly. But if you look back in history, you guys can probably think of another time where the US also had a catastrophe or a recession that was because of housing, construction, home prices around 2008, and we made it out. One way or another, I have faith that China is going to be coming out of this stronger, just like the US did. I don't know exactly how they're going to do it, whether that's a lot of government stimulus or just waiting it out, or it might not be as bad as we think. Now, that's not to say it couldn't get much worse, and I could be totally wrong here, but I know the country has gone through situations like this before. Other countries in the world have, and they've gotten through it. They've figured it out, and I feel like China is as well. But that is a serious risk. And to show you guys something that I touched on earlier, the larger generation headed into the 35 to 45 age group, here's a population pyramid of China through 2024, and you can see the age groups that they have, and they have a little bit of an increase right through here, this 30 to 34, 35 to 39. Those age groups are slightly larger than those before and after them, and they're entering into this between 45 to 35. They're all going to be within that age group, which is prime spending years. And I think this tailwind is really going to push China to have continued growth, albeit maybe not as quite as fast of a pace as they had before, as it was a pretty breakneck pace. But I think it's going to continue to drive consumption in the country, which again, bringing this back to Alibaba is just going to be a good tailwind behind them. So that lays out for you guys some of the tailwinds and the headwinds that I see and kind of how they play together to give you a picture of Alibaba's operations and what they actually do in the country that they do it in. Now let's take some time to go over the company's current financial position, so that way you can understand how they've actually been operating in this environment and where you kind of can get an idea of where they're headed. Have a stock chart pulled up here from their IPO in 2014 all the way to their high in 2020 and dropping off very sharply until today. You guys can see they've had a wild ride. So let's get an idea of actually what this company's financials are, and we'll take a look at a few things there, just going over things pretty quickly, but giving you guys a good idea of where this company actually sits. When it comes to evaluating a company's financials, I like to keep things very simple and clean. I don't think it's necessary to know down to the exact penny where you see things going in the future. Having a solid idea and understanding of how the company operates is very important. So with that, let's dive in. As you guys can see here, I have their income statement pulled up, and keep in mind this is in the Chinese local currency, the yuan. This is not in US dollars, but we can certainly take a look and see how quickly their revenue is growing quarter over quarter. And they actually just reported a most recent quarter that isn't included here as well, where their revenue grew about 5% year over year. And you can see over time, they have a fairly cyclical business with ups and downs all throughout this. So to give this a little bit more of a smooth picture, we are going to go to the trailing 12 months to give us a better idea of where things lie. You can see they are continuing to grow, albeit at a slower pace than they had before. And you guys can see that right here. And as companies get larger, this is natural. However, they have a little bit of stagnation right now, more so, which I think is contributing to the negative sentiment around this stock. But I want you to see they are still growing. and their gross profit is actually growing at a slightly quicker pace than their revenue, which is great to see. Now let's move over to the balance sheet. Anytime I'm reviewing a company, I have to make sure that there is no solvency risk, or at least I can understand that the solvency risk is not going to come to fruition. On their balance sheet, you can see that they reported about 758 million yuan in the most recent quarter as their current assets, and as current liabilities, they have less than 400 million, meaning that they are able to pay off their entire current portion of their debt with cash left over, and their non-current liabilities of also under 400 million puts them in an extremely strong situation in their balance sheet. And as you guys can see here, they have about 65 billion US dollars in cash or cash equivalents sitting on their balance sheet, which is incredible. And we'll talk more about how they're actually putting that to use later. So this is super quickly how I look at a balance sheet, and just wanting to make sure, hey, are we in any immediate trouble here or trouble coming down the road? But you can see this company right off the bat, they've got tons of cash and they're able to pay things off. They are not debt heavy and they're in a good position. Now, the last and most important piece that we're going to look at is cash flows. Cash flows are king, and you guys are going to see why and how I actually determine what a company is worth today using a discounted cash flow model and going through to give you an idea of what I think this company's intrinsic value is. But first, let's take a look at cash flows. Here we are going to also put this to trailing 12 months to smooth things out and give us a better idea of where they're actually headed. So one thing that you'll actually notice here is because of this trailing 12 months and how they're connecting, this is actually pulling only operating cash flow in and not CapEx. You can see that their free cash flow and their cash from operating activities is the exact same. For whatever reason, it didn't pull in CapEx, but that's okay. This still gives us a really good idea, since I know that their CapEx is a very small percentage of their actual cash flow, at least when comparing to other high capital intensive industries for sure. So you can see in 2023 and late 2022, their cash flow has returned back to growth from a stagnation in 2021 into 2022. You can see there's certainly some cyclicality here, but overall they are growing, and they are growing very well. Just to give you guys a better picture of what this actually looks like, you can see the growth here and into 2021, 2022, where China had its zero COVID policy that really stifled growth. You can see how much that hurt their cash flows, but they're returning to growth here, which is really great to see. So to give you guys an idea, this company is generating an immense amount of cash. We saw that this company had about 400 million of long-term debt on their balance sheet, and they're generating over 200 million in the trailing 12 months, which is amazing. They are generating a ton of cash. So give you guys an idea of what their balance sheet is actually looking right now. They have had growth, but are kind of stagnating a little bit as they return from the zero COVID policy, which is creating a little bit of fears that they might be turning a corner and headed down negative. But as we discussed before, there are many tailwinds that I think are going to continue to drive this, along with some others directly from the management that I'm going to be sharing with you guys here in just a minute. The next piece that we're actually going to be taking a look at is the most recent quarter's reports, both looking at the transcript from the earning call and the report that they put out, taking a little bit from each and discussing what the management is saying about the future of this company. So let's take a look. As you guys can see here, this is the performance of the company over the past quarter and how it compares to year over year. The wholesale part of their company only grew about 2% year over year, which isn't great, certainly, especially when you consider this is the biggest part of their revenue. Their cloud grew at about 3%, where their international commerce grew over 50%, 56% year over year. Their logistics network grew 24% year over year, and you can see every section except for this all others increased year over year, which is fantastic to see. And you've got some really great performers in here, with their logistic continuing to be a bigger and bigger piece of their company, along with their international retail growing very significantly and starting to be big players between the two. Now, coming down here, the company in their earnings call and in their report said several things that I want to highlight that you guys will see. They said to maintain their competitive edge, we increased our investment in core capabilities and adopted a more aggressive approach towards competition in order to win growth. Our top priority is to reignite growth of our two core businesses, e-commerce and cloud computing. So up here, these two, this e-commerce and retail, along with their cloud, they want to re-accelerate growth here, which will be huge. And that's the focus that they have right now. They said Alibaba's cloud overall profitability continues to improve, and we will enhance our growth rate, a common theme here. And we're going to touch more on the profitability of their cloud, which is honestly incredible to see. I'm very excited about this, and you guys will see why here shortly. Again, they're talking about returning to growth. 2024 will be a year of comprehensive capability upgrades and a year of significant investment. They are confident that they will return to growth. There's a very common theme here, guys: return to growth. As the country comes out of the zero COVID policy, as stimulus is put in, as age groups move into core spending categories, and as the country pulls more people out of poverty, they're looking to capture that as well, which is amazing to see. I love to see that they're focused on this because they have a really good opportunity in front of them. In their international e-commerce section, their total orders grew by 24%, and AliExpress achieved year-on-year order growth of over 60%, which is absolutely incredible to see. Trindle, which is a big player in Turkey and international countries, continued to achieve robust double-digit order growth and expanded its business in valuable new markets in the Middle East, which is really amazing. They're capturing a lot here. They say they have huge potential for their international commerce and retail business to increase user penetration in major markets overseas. You can see again where they said overall they grew their revenues by about 5%, EBITDA increased by about 2% here. Their cash flow year on year decreased 31%, which they say the decrease in free cash flow was attributed to increased CapEx, meaning they're investing more in the growth of their company. So they're not actually just saying these things, hey, we are going to reignite growth. They are putting money to work here, and they have a lot of money sitting on the sidelines to do, which is really, really exciting. Their revenue for Taobao and Tmall increased about 2%. Their China commerce wholesale business revenue increased 23%. And they're seeing early signs of growth recovery driven by investments made since earlier this fiscal year, which is really cool. I'm excited to see this in this upcoming quarterly report. Are we actually seeing this growth return? And what are we actually going to be looking at going forward? They said also our cloud intelligent group's revenue quality continues to improve as we proactively reduce revenue from low margin project-based contracts. Cloud's adjusted EBITDA increased by 86%. This is huge, guys. You saw that their revenues from their cloud didn't really grow that much, low single digits, but that's because they are proactively reducing revenue from low margin based contracts. They are firing customers that aren't profitable and don't generate a lot of revenue. That's going to suppress that. As soon as they feel like they've cut out that bottom piece of profit generating customers, they can really return to growth there, and you can see their profitability is increasing dramatically here. Alibaba International Commerce revenue was increased 44%. Revenue from international wholesale increased by 8%. Their logistics wing grew 24%, along with other areas that are growing as well. Another piece that I love to see, they announced another 25 billion of share buybacks, bringing the total to 35.3 billion under our share purchase program, which they talk about later, their thoughts on why they actually increased to this amount. And they said that their target is to achieve 3% annual reduction in total shares, which is really, really cool. Another thing that they said, the take rate on our platform is still relatively lower compared with other platforms, which actually shows big potential for increasing take rates. Now, take rates are essentially the fee that they charge for other companies listing their products on there. So per item purchased on there, what is their take? What's their piece that they're getting? And they say them compared to other companies, their take rate is low, meaning they have room to grow, but also they're a low cost player in this, and it's going to bring a lot more people to the table and want to use them as the platform to reach customers, which was really cool. One of the things recently that the company announced that people took very negatively is the spin-off of one of their internal businesses, that they decided to not do that, and they are explaining here why, and there's also several others that they were looking to spin off, and why they actually decided to hold off and not do that. Essentially, they're looking to sell high. They don't want to sell when pessimism is really dominating the market in China, and they're not going to get the money that these companies are actually worth, which I think is extremely smart. There are so many companies that I think just do things for the sake of doing them, but they're actually thinking here about how this is going to impact them long term, and they want to get fair value for them. And if they can't, they're just flat out not going to do it. And I really like to see this in management in the style. I absolutely love this. I love share buybacks and how they're able to increase the ownership in a company of investors without having to do anything on our own. But I love how they're actually thinking about this and coming to the conclusion that they can offer the same return, even if price does nothing, as a 10-year treasury, just because of the buybacks of shares and the dividend. I really like that. The next piece, they talked about AliExpress, which we didn't dive into it here, but this is their international piece where they're actually implementing something very similar to Amazon Prime, where they have quick delivery, great customer service, things like that. And it was one of their loss leaders. And they discussed why they feel like it was a loss leader and why they're still continuing to invest in it right now. They're seeing growth across here, but they're investing really heavily in delivering above and beyond quality to stand out. And once they have that scale effect and delivering thousands, millions of orders, they're going to become profitable. It might not be the highest margins, but it's going to be a profitable business that's going to win customers for them and grow their profit. Those are my highlights that I took from the most recent quarterly report that the company announced. And you can see there is a lot to be excited about. Despite the pessimism around the company, The management is focusing on reigniting growth, which is going to re-rate the company, increase their multiple because it's trading at very low multiples right now. They're going to increase the amount of profit that they're actually driving and positioning themselves very well for the future, along with reinvesting a ton of the cash they have right now to buy back stock while it's cheap. So with this all in mind, you can see that I believe that there is a lot to be excited about on this company, especially when you think about how much their stock has fallen over time. But we've seen that their revenue, profitability, and pretty much everything across the board has been growing. Getting a severe mismatch here, which is why I think this is so exciting to take advantage of. But keep in mind, I talked about some of the headwinds that I see, and some of them could be much worse than I imagine. I could be completely wrong here, but I'm willing to live with that because I think I have a good understanding and feel comfortable with the ability of this company to continue to grow and use the cash that they have on hand to not only buy back stock, but to reignite growth, just like they talked about. So that's where I see this company headed at in the future. Maybe not growing as fast as they had, but at a fairly moderate pace where they can capture a lot of this and are going to kind of mature and increase profitability as each of those segments of their business matures as well. And they can cut out losses, become more efficient, and all of those things. So that's where I actually see this company at and headed for the future. They're not going to be an insane grower, maybe in a few segments, but overall very, very solid. So with that, I actually want to show you guys how I go through, now that we've laid out this company, you can see the different industries that they operate in, the country that they operate in, the most recent quarterly report, how the management's thinking about this. You've seen a balance sheet and everything there. How do we actually go about valuing this company? And again, I want to keep this super simple. I'm never going to pinpoint to the exact penny, dollar, $10, where the company is going to land or where fair value is at, but I can at least give myself an idea of saying, I think this company is significantly undervalued, and this is a range within. I think that the company could be valued, or the intrinsic value is at right now and 5 years in the future, which is kind of my time frame that I like to look at. With that, let's look at a discounted cash flow model. One quick thing before we jump into the discounted cash flow model. At the beginning of this video, I said cash flow is king. And I want to take just a second to explain why I actually think that is. When you look at a company's balance sheet, there is often a focus on the revenue and the profitability, which I think is great. It's fine to look at that for a company, but there are many different things that go into that where revenue and profitability can actually be a little bit more of an opinion. For example, this quarter, Alibaba actually reported a pretty significant decrease in their profitability, which was due to impairments in pieces of their businesses, which is a little bit of a guessing game in determining what that company is actually worth today. They decided behind the scenes that they said, hey, we purchased this or made this investment. We thought it was worth this, but we decided it's actually worth less. But there's not really any actual basis to say they got it exactly right. It's them doing their best to come to that conclusion. And that amount actually didn't even affect how much cash they made. They just have to report it and say, all right, it's worth 50 million less than we thought, so it's going to decrease our profit by $50 million, even though no cash actually changed hands or anything at all. But when you look at cash flow, it is fact, right? As much as fact can be. Cash flow is a much less subjective amount. It is what it is. How much cash did we actually receive, and how much cash did we actually spend to purchase equipment, to make investments in our company? So that's why I think cash flow is king. It is what it is. It is fact. Whereas profitability in some businesses, in some instances, is a little bit more of opinion. So pay attention to the cash. Definitely pay attention to revenue and profitability, but I would not say to put it above cash flow in a company, which is why I think to focus on discounted cash flow. All right, guys, coming into this discounted cash flow model, I want to show you guys what I'm actually thinking about here and using Stock Unlock, which I really like their tools. That's what I've been using for a lot of the financials, all of the financials that you've seen here. Coming to this discounted cash flow, let's see what my assumptions are. I'm just looking 5 years out. I want to find companies that have opportunities now, right? And they're undervalued now. So my time frame is slightly shorter. You could certainly look at other time frames looking out to 10 years, which might give you a little bit better idea. I am assuming a 7% growth in their free cash flow. Over the past 5 years, their free cash flow has grown an average of about 16%. I'm assuming much lower than that, trying to be a little bit conservative, but as I think they return to profitability, I think this is a reasonable number to assume, and we'll look at one other just to see if they grow a little bit faster than this. Their outstanding share growth rate at 3%, which is what a little bit less than the company is targeting. The price ratio of 18 times free cash flow, which is, I think, kind of in the middle. I don't think it's necessarily low or very high. It's in the middle. I'm happy with this. With a company that has a lot of opportunity for growth, I think 18 is reasonable. And I also overrode the free cash flow metric. As I mentioned before, in the trailing 12 months, it actually wasn't taking into account the CapEx or the most recent quarter that was announced. And so I actually went ahead, and this is roughly where their free cash flow will sit. I think it's off slightly, but it's very close to give us an idea. So you guys can see, and you've probably already been looking at, with these assumptions, the current stock price is 72 and their fair value sits at 168. And that price will give you a 10% return at 168. At its current price, it projects that you'll have a cumulative average growth rate of over 30%, which is honestly incredible to see. This is the type of things where it's so obvious that the cash that this company is producing far exceeds what its value should be. I love this line that they have right here. This green actually says, at this multiple of 18 times, what should the price have been based on the free cash flow? You can see over this time, I'm underestimating the price ratio. Most of the time, it was over 18 times price to free cash flow. And you can see it kind of followed along with it. It was going up and down as it went up and down until here, when cash flow continued up and its price continued down. These are the discrepancies you want to look for. And you can see, projecting this out, that they are having a future stock price of around 270. This is just an assumption. This may not happen at all. This is just assuming intrinsic value. Who knows? This stock price might go down in between now and then. I do not have a crystal ball, but this is a good idea to tell me, hey, it is obvious they are undervalued. And these are the kind of companies that I want to be in. Solid balance sheet, growing revenue, growing cash flow, great opportunities looking for good management with experience, and operating in a country that I think overall has good tailwinds to drive growth. Let's change the metric just slightly to assume a higher growth rate of around 9% free cash flow and a 20 price ratio. Even if we just assume that, then that pushes the cumulative average growth rate up to 35.6 and a future stock price of 330. Hopefully it's obvious to you guys why I like this company, and you can take this video and it gives you good context as to what I'm actually looking at here. This is my opinion, not advice. Do your own work here, but I wanted to show you guys my thought process, and I hope you got some value. Let me know down below, and I'm going to continue to do this going forward, trying to dive deep into value in companies and giving you guys the details of what I'm actually looking at behind the scenes. See you guys in the next one.